Vinay Jaising, the MD of Portfolio Management Services at JM Financial now is also joining in. Vinay, your view for the markets in 2023 is the first half may be a difficult terrain to navigate for global equities. India is likely to outperform. What's the best way to play then this first half? Is it go long on domestic names, avoid the exports? Tell us the 6-month view first.
Sure. Thanks for the opportunity. First, the way we look at it, the India resurgence story, as you can see in the loan book growth of 17% year on year, makes the private banks and some public sector banks a must to own. So that's where we need to be overweight. And the second space where we need to be overweight is the Make in India story. Make in India story emanates from a couple of spaces. One is specialty chemicals. The other is contract manufacturing. And the third is manufacturing, be it an auto or otherwise, wherein India is becoming a source for them and where we are earning dollars and the cost is in terms of rupees. So these are the two spaces where we would be overweight in the first half of the year.
So just to take that forward, Vinay, you said manufacturing including autos, but you just want to understand which are the pockets that you like. Because if you go through the data with a fine-tooth comb, you'll realize that a lot of pockets are actually seeing pressure. There's, of course, two-wheelers that have not recovered yet. Even in the larger guys, right? I mean, if you look at Maruti's numbers, for example, the last 3 months in November, they did about 1.5 lakhs of wholesale sales compared to they were at about 1.8 lakhs in September. So month on month, it's actually a fall that they've seen. So where are you seeing pockets where there is a high degree of outperformance in autos?
Sure. Thank you. So auto ancillaries, companies like Craftsman, companies like Escorts, which are going to become the tractor hub for the world coming in from India. These are the two spaces where we are most excited about. Obviously, if you want to play the FMCG chain, Maruti, but Maruti for us is now getting closer to fully valued. We do have it in our portfolio though.
Okay, all right. Hi, Vinay. Vinay, I wanted to ask you about a couple of these chemical names. Gujarat Fluoro and Sumitomo Chemicals. I think you're positive on both those two names. Tell us more.
Sure. So as far as Gujarat Fluoro is concerned, the story for us is pretty simple. There's been a change in management, focuses on the product which we like, which is the fluorine chain. And even in the fluorine chain, it is in the specialty chemical part of the fluorine chain. If you were to look at valuations for Gujarat Fluoro, they're trading at 25, 26 times 1 year forward as compared to its peers, which are trading at close to 40 times. So that makes it a favorite for us. Good earnings growth, good product profile, and good exposure to global markets. Looking at Sumitomo, again, it's part of our Make in India story, wherein the parent Sumitomo from Japan is getting it orders, export orders coming in from US, and India is becoming a hub for production. Today, exports are accounting for about under 20% of overall sales for Sumitomo. And that number, our analyst Sudarshan tells us, should go to as much as 40% in the next 2 to 3 years. Earnings visibility here, again, for us is north of 25 to 30% year on year as far as bottom line is concerned, which is why we like Sumitomo as well.
You said you like specialty chemicals as a Make in India theme, right? Vinay? How does China reopening change this or impact specialty chemicals?
So, couple of things. First, we all are aware that, the Make in India story is China plus one, put in different words. So China opening will increase the demand for China, and also where the product availability were not there for a couple of these specialty chemical companies, that would improve. But the way we are looking at specialty chemicals, and you mentioned a couple of the names earlier, I would add one Archean Chemicals to that, is if the raw material is more so based in India and you can avoid buying raw material for China, the story gets even better. So for us, reopening of China is more a demand growth story and better supply stocks, but we are not buying those companies wherein there is any raw material or a large portion of raw material coming in from China. So it won't make an impact to us, but to the entire specialty chemical space, it would be a lot more positive.
There's so much happening in defense, aerospace, railways, right? I mean, we were just hearing from Baba Kalyani as to how Bharat Forge has now finally secured a big artillery guns order in Europe. And of course, defense stocks back home have been on a tear as well, BEL, etc. Do you still like these names, or do you think that the best is over in terms of a stock price move?
Sure. See, for us, again, I'm harping on the Make in India story. and the previous speech you had from Baba Kalyani, India is also becoming a hub, if not for export market, at least for replacing what was coming into the rest of the country for the defense. The company we like out here is Hindustan Aeronautics in the airport space. What's very important out here is, with Tejas, which them doing so much of maintenance work for engines of couple of Russian engines, which are, coming up for renewal as far as India is concerned. That makes us believe that the short-term story, which is the next 2 years, earnings growth profile for companies like Hindustan Aeronautics is 10 to 12%. But as you move from 2024 onwards, exports would become a big pie for it, and the earnings trajectory could move from 10 to 12 to probably 14 to 15%.
Okay, all right. Vinay, I wanted to ask you about the headline index. Everyone's talking about the Nifty being expensive at around 22 times odd. What kind of an earnings growth are you factoring in, point number one? And are you in the camp that believes we are expensive at current levels? What's the downside risk then?
Sure. Thank you, Nigel. It's a tricky question because, today, obviously, we are at an all-time high. That's one way of looking at it. The other way of looking at it is we are about 100% premium to emerging market and about 50% premium to MSCI World. That makes us on a relative basis expensive, but as our earnings trajectory has shown, our resilience to earnings is pretty solid. And on a one-year basis, since the Indian markets have gone nowhere to 5 to 6%, and the currency has depreciated by about 8 to 10%, for a global investor, we've not made much money. So time value of money for the Indian market for a year, despite a growth of 15 to 16%, has been zero. So on an absolute basis, we've lost 1 year of value. Having said that, our earnings growth we are seeing is 15 to 16% forward CAGR from this year to 2023 to 2024. So we see the EPS of 810 moving up to even 1,100 levels for F25. So if I were to talk to you 1 year forward, therein, we would be looking at a rolling EPS of somewhere close to 1,050 to 1,060. If I use the average 5-year multiple of 20, a 21,000 index on a base cases cannot be forgotten for next year. Put the other way around on your second question on the bear case. If you use the same multiple of about earnings of about 1,060 and take a multiple of 16, which was the last 10-year average, we can visit 17,000 levels. So next year for us would be, more a trading zone of 17,000 to 21,000, but with the first half of the year being a lot more attractive when the world has so many headwinds.
Vinay, thank you very much for joining in. That's Vinay Jaising of JM Financial. Let's get into a very short break on that note. We'll come back and get you